Good afternoon and welcome to the latest episode of the Stoll and Degon webinar series. Today we'll be talking about the all-important Employee Retention Credit, also known as ERC. Okay, we're not advancing. One second. Greg? Okay, here we go. Sorry about that, technology. My name is Marty Croyle, and I'm happy to be joined today by my colleague, Harry Weber. And for the next 35 or 40 minutes, we're going to be talking about employee retention credits. But before we move into that, a couple of housekeeping issues. We encourage any and all questions. We ask that you type them in the chat, and we will address as many as we can at the conclusion of our remarks. And if we cannot answer your question today, we will respond to you next week, as long as we know who left the message for us. This presentation is being recorded.
Marty, you want to mute?
Okay. After the webinar, you'll see a short survey, and we hope that you will fill it out. It will help us make all future webinars the best we can make them. We have a webinar that we're planning to have in August. It's tentatively scheduled for August 19th. We're going to talk about the new lease accounting rules that are coming into play in 2022. Greg, we're not advancing again. Okay. If you could just please read this quick disclaimer. This speaks to the issues of the day. We are asking you if you need help, to call our office, and we will be happy to assist you. This is the best information that Harry and I have to share with you today, July 1st, 2021. Information does change from the Internal Revenue Service and the SBA, so please look for updates, but please contact us if you need help. Today, we're going to talk about three topics. We're going to briefly talk about PPP loan forgiveness. Then Harry's going to talk about the employee retention credit for both 2020 and 21. And I'll finish up with the interplay of PPP and the ERC programs. And then we'll get into Q&A. Before we start, the first section is loan forgiveness. What would a Stoll and Degon webinar be without talking about PPP for a few minutes? The only thing I want to say about this topic is that if you got a loan, PPP first draw, or number one, back in April or May of 2020, as many of you did, your deadline for filing that forgiveness application is coming soon, okay? For example, if you received your money on or about April 30th of 2020, your covered period would take you out to October 30th, 2020. And from there, you have 10 months to file your forgiveness application with the lending institution you worked with. That's approximately August 30th. Now, if you got your money on April 4th, you got to move that August 30th deadline up to August 4th. So for those of you who have not filed your forgiveness forms, please get at it. My understanding is there is no relief if you're late. And if you're late and you don't file on time, you repay your loan. So that'd be a serious mistake. If you need help, please call our office and we can assist you with this loan application process. I'm getting client questions now about PPP2 loans. So some people were eligible for a second draw. Many of them were getting their money in late 2020 and early 2021. And the banks are now opening their forgiveness portals. People are saying, should I file yet? My answer is wait. Wait until your covered period is over, because many of you who received your money in January, February, March, you're still in your potential covered period. So wait, and particularly if you're eligible for any ERC credits in 2021. We're going to get into this in a moment. Before we turn it over to Harry and talk about it, I want to talk about two or three items. One of them is aggregation rules. If you are a company that has commonly controlled entities, like a parent sub or brother sister companies, all of these entities need to be treated as one unit when you're doing all of these tests for ERC that Harry's going to talk about. So if you have 10 sisters and 4 of them pass the test and 6 of them don't, and the overall group doesn't, nobody gets to ERC credit. Everything is done as a single group. If you're not sure if you're part of an affiliated group, please contact the office and we will assist you to determine whether or not you are part of an affiliated control group or not. Gross receipts. We're going to talk about gross receipts. We've talked about this in prior webinars, and here is the definition from the SBA. Okay, primarily it's sales of your products or services received or accrued. Translation, it's cash basis or accrual basis. You have some discretion there. You also will include interest and dividends and rents and royalties and fees and commissions. And we have clients that have solar panels on their roofs, and they will include that sale of electricity back to the grid as part of this calculation. It doesn't include any forgiven PPP loans, which are treated as other income when they're forgiven, nor does it include capital gains and losses. And the IRS has a similar rule when it comes to ERC, okay? So we prepared a little table here that we're going to revisit at the very, very end when it might make a whole lot more sense, but just as an overview, the columns are PPP2, that's the second draw, and many of you were able to get that. Then there's the ERC rules for 2020 and the ERC rules for 2021. The governing body, why does this matter? The SBA is overseeing the PPP and the IRS oversees the ERC. Why does it matter? Well, they are both obviously government, parts of the government, but they have different rules and percentages for their programs, sometimes different definitions, okay? And this is one of the reasons why I think a lot of people get all of this stuff mixed up, the PPP and the ERC, and it's easy to mix it up. The definition of gross receipts that we went through on the previous slide is virtually identical for both the ERC calculations and the PPP calculations. The gross receipts test, I'm only going to touch on this. All I want you to see here is that the test that Harry's going to talk about have different percentages depending on which program you're in. There's quarterly receipt reductions in 20 versus 19. It was 25% for you to get your PPP2 loan. It's 50% to qualify for your ERC for last year, and it's 20% going forward in 21. So a lot of people are confusing these things. Harry will go through this, and then we'll touch back on this slide at the very end. The maximum benefit for each of these. This is important. The biggest loan you can get from PPP2 was $2 million. So that's the maximum benefit. If you pay all your eligible expenses out, you'll get a forgiven loan of $2 million. The ERC for 2020, the maximum benefit for a company is up to $5,000 per employee for the entire year. We fast forward to 21, and it is $7,000 per employee for each quarter that you qualify, okay? One last thing, I've had some questions from people during the last few months. Why didn't we hear about ERC along the way? Why didn't we hear about it last year? Why are we just hearing about it now? ERC and the PPP were both birthed about the same time, last winter, last spring, and they were both set up to help businesses deal with COVID-19. But up until December 27th of 2020, the very end of the year when a new bill was passed in Congress, if you had a PPP1 loan, you were not eligible. You were ineligible for ERC. And on 12/27/20, that all changed. And that new law said, if you got a PPP1 loan and you are eligible and you meet the rules, which Harry will go through in a minute, for ERC in 2020, then you can get them both. And suddenly the world changed for our profession, and we started spending more and more time learning more and more about the ERC. So that's why you didn't hear about it for the longest time. So now I'm going to turn everything over to Harry Weber, and he's going to discuss the ERC program.
Awesome. Thanks, Marty. So for a qualified employer, so how do you know if you qualify for the ERC in 2020 or 2021? So for both 2020 and 2021, your business can qualify in one of two ways. The first is if your business operations were partially or fully suspended due to a government order being in effect. This is still a bit of a gray area that the IRS hasn't provided much guidance on. There's no real bright line test, and a lot of it's very facts and circumstances. So this is something that we work on with a lot of the clients who aren't sure if they kind of fall under this partial full shutdown rule. For example, if you have multiple service lines and only one of those are impacted, and it may not be considered even a partial shutdown, depending on how important or nominal is the term the IRS uses, how much that is a part of your business. So this test is the same for both 2020 and 2021. It's definitely the more difficult one to know whether or not you pass for 2020, and for 2021 it'll be even more difficult with most of the restrictions being lifted early to late Q1. So the second method is the one most people are probably more a little bit knowledgeable about, and this is whether or not there was a significant decline in gross receipts. So while this test applies to 2020 as well as 2021, the qualifications and potential credit amounts are different for 2020 and 2021. So we'll take a look through those now. So you can see here, if you meet one of the two requirements to qualify for ERC, how much is your potential credit? So for 2020, you can receive a credit for 50% of qualified wages paid to an employee, up to $10,000 of wages per employee per year. So the maximum amount of credit for an employee for 2020 would be $5,000, assuming that they had $10,000 of qualified wages. So for 2021, there was some significant changes that dramatically increased the amount of potential credit an employer could get for each of their employees. One of these was that the percent of qualified wages increased from 50% to 70%. And the other was that it was now on a per quarter basis rather than an annual basis. So for the same employees in 2021, or so looking at 2020, you had up to $5,000 per employee for the year. So taking that same employee for 2021, you would have a maximum of $7,000 of a potential ERC credit per quarter, or up to $28,000 per employee for the year, assuming that you qualify for each quarter in 2021. So here's an example of Marty's new pizza shop, Marty's Pizzeria Inc. So for purposes of 2021, we're assuming that they have 10 employees who have each made $10,000 per quarter and meet the gross receipts test, which we will go through. But since we're here, the difference, one of the big differences between 2020 and 2021 was that the gross receipts tests in 2021, your gross receipts only had to be down 20% or more from the same quarter in 2019, which we will go through in more detail in later slides. But so if we take a look at this, we're assuming that they meet the gross receipts tests, and if they've paid them, $10,000 of qualified wages per quarter, they're looking at a potential $280,000 credit, assuming that they meet that gross receipts test for each quarter in 2021. All right, so here's kind of where we'll look at the differences in gross receipts tests between 2020 and 2021. And kind of going back to 2020, it might make sense to actually start with the change to the definition of whether or not you're a large or small employer, right? So for 2020, if you were considered a small employer, which had 100 employees or less, you could get your qualified wages were considered wages paid to both employees that were working and not working. Whereas if you were a large employer, it would be only the wages paid to employees who were not working. for 2021 purposes, that 100 employees increases to 500. So if in 2021, if you had 500, an average of 500 employees or less per quarter, you would be considered a small employer and would get the benefit of including wages paid for both employees working and not working. So taking a look through the 2020 test, in 2020, a small for a quarter in 2020 to qualify under the gross receipts test, it would have to see at least a 50% drop in gross receipts for the same quarter in 2019. So subsequent quarters would then qualify until you reach a quarter that's only 20% or less drop in gross receipts versus the same quarter in 2019. So for example, say at the end of Q2 2020, you had a 50% drop in gross receipts compared to Q2 2019. And at the end of Q3 2020, your gross receipts were 80% of what they were in Q3 2019. That's where you would, that's sort of your period you would look at for qualified wages paid for getting an ERC. So in this example, you would look at your qualified wages paid from the beginning of Q2 2020 through the end of Q3 2020. So you need one really bad quarter, essentially. And for 2020, once you kind of have that bad quarter, it keeps going through the quarters of 2020 until you hit that 80% threshold of a quarter in 2020 compared to that same quarter in 2019. So as we mentioned earlier, for 2021, your business to qualify for the ERC for a particular quarter, you only need to have a 20% decrease in gross receipts from the same quarter in 2019. And this should allow a lot more businesses to qualify for this credit than in 2020, when you had to have at least 50% decline in gross receipts. So, and in addition to that, there was this inclusion of for 2021 of the prior quarter method, which has largely not been talked about enough, because it can really provide a really big benefit for companies who may not qualify in each quarter of 2021. So what this does is it basically says that you can elect to use the previous quarter's gross receipts test to determine if you qualify for the current quarter. So for example, if in Q2 of 2021, you didn't have a 20% drop in gross receipts compared to Q2 of 2019, you can look at Q1 2021 gross receipts versus Q1 2019. And if you wanted to you can use the prior quarter method for Q1 2021 as well, but you would compare Q4 2020 versus Q4 2019. So thinking about this from a different perspective, say you did qualify in Q1 of 2021 using the normal gross receipts test approach, just comparing Q1 2021 versus Q1 2019, you would know that going into Q2, that you will automatically qualify for the ERC in Q2, because even if you didn't qualify under the normal approach of looking at your Q2 activity, you would qualify using the prior quarter method, because you knew in Q1 that you passed that gross receipts test. So here's just a basic example of the ERC for 2021 and how they qualify. This isn't looking at the prior quarter method. As you can see, Q1 and Q2, they're both down they're both down 21 and 25% from their respective quarters in 2019, and they would qualify for the ERC and not need to use the prior quarter method. So the next couple slides are really just to kind of reiterate the benefits of the changes to the 2021 ERC from having the prior quarter method, and how that can be used to sort of approach subsequent quarters. So going back to our previous example, if you qualified for the ERC in Q1 of 2021 using the normal approach, and looking at that you'll qualify for the ERC in Q2 at a minimum by using the prior quarter method. And because of this, you can work with your payroll companies to reduce your tax deposits ahead of time, knowing that you'll qualify. So rather than having to wait until the quarter is over and having to go back and request the ERC as a credit on your payroll return, so you would essentially be able to sort of plan ahead of time. We still recommend that everybody looks at that quarter to try and qualify using the current quarter's gross receipts, because that will just allow you to kind of keep using that prior quarter method for a following quarter. But if not, you know that at a minimum, you'd be able to use the prior quarter method in Q2 because you qualified under the normal approach in Q1. So these are just some more information on the prior quarter election. Basically, kind of just the 2-for-1 is what we mentioned before. So the 2-for-1 approach is basically saying that as soon as you qualify for one quarter, you would qualify for at least the next quarter under this prior quarter method. So it does give you some flexibility in terms of reducing your payroll tax deposits as you go through 2021. And I do believe there's the ERC hasn't been extended through 12/31/21, but there's still and the belief is that also this prior quarter method would be applicable for each quarter, but we're still waiting for some more guidance from the IRS. I think we have a hand raised. Go through it now. Marty,
to ask a question.
Yep.
Greg, you need to unmute him.
He can unmute. Luke, you can unmute yourself, I think.
If it doesn't work, feel free to also type it in the chat, and I can either respond through there or I can talk about it.
Yeah, it's not working, so maybe. Oh, wait a minute. Luke, you can unmute now.
Well, let's, Luke, if you could put your question in the chat. Sorry about that. Zoom technology sometimes is a little overwhelming.
Yeah, so just touching up on those slides, and then I can answer that question as soon as it's out there, or we get a chance to hear from Luke. But this is sort of just another example. Oh, sorry, is it coming through?
No.
No? Okay. And this is just kind of going back to Marty's Pizzeria, where we looked at it using the normal approach for both Q1 2021 and Q2, where they were down 20%, 25% respectively in both quarters. They didn't need to use the prior quarter method. So here we're just kind of showing the example of in Q1 they were down 21%. In Q2 they weren't down 20%, but they'll still qualify for Q2 because they'll use the prior quarter method, knowing that in Q1 they actually did meet that test. And this is kind of just discussing the example we just went over, where if you look at the bottom, you can see Marty can qualify for both quarters, Q1 based on actual Q1 percentage and Q2 based on election to use Q1 percentages. I think that wraps up, so I'll hand it back over to Marty.
All right, thanks, Harry. I'm not sure if Harry's trying to give me a message, as he's naming a pizzeria and a barbershop after me. Maybe he thinks I should leave the firm. I don't know. I hope not. Nice job here, Harry. As you can see, looking at these rules, they're complicated. And as Harry mentioned, we're awaiting further guidance from the IRS. We got a big document from the IRS around the 1st of March. And it was the only authoritative literature at that time we had on the ERC program. And we've had a couple of small things since then, but really small. And the AICPA, our professional American Institute of CPAs, has been lobbying the ERC for further guidance for months. So we expect to get more information on all of this, hopefully in the coming weeks and months. So I'm going to talk about the interplay of the PPP loan forgiveness and the ERC program. So this is the most important thing for everybody to understand. The PPP loan forgiveness is the most valuable thing on your plate, more valuable than the ERC, which is why back in 2020, people went after the PPP loan rather than go after the ERC credit, because the PPP was going to give them a bigger bang for their buck. So everybody's priority, if you got a PPP1 loan, get that forgiven. If you've taken out a PPP2 loan, get that forgiven. That's the most important thing in your plate. Otherwise, you've got a loan to repay. Then when you have the PPP loan forgiven, then you spend time figuring out how to maximize the employee retention credit, okay? So loan first, ERC second. This is a very important rule, and that we don't need further guidance from the IRS on this. You cannot use the same payroll dollars that your company paid to get your loan forgiven for your PPP loan forgiven and to qualify for the ERC credit. You can't use the same payroll dollars. So if a borrower is eligible for both PPP and ERC, you need to go through a strategic analysis of all of your eligible costs, including payroll and all of the non-payroll eligible costs that are allowed, and we'll go through those in a second. You need to go through a strategic analysis to determine how much payroll you need to put on your PPP forgiveness forms. Because if you put too much payroll on it, you may not be able to use that same payroll on your ERC application. So in other words, if you have a PPP loan and you weren't eligible for ERC, which was for a lot of people what happened in 2020, it's no big deal. Just it simplifies the loan forgiveness process for PPP1, and it allows you to just allocate all of your payroll to the PPP program and none of it to the ERC. So what a lot of people did when they filled out their 3508, which is the PPP loan forgiveness application, which you sent along to your financial institution, the only expenses that many people put on that form, line 1, was payroll. They excluded all of the other non-payroll items because they didn't need to save any payroll to give them ERC credit. And conversely, if you were eligible for the ERC credit and you didn't get a PPP loan, which might happen in PPP2 because there were restrictions on the ability of companies to get loans, then you would do the exact same opposite. You would allocate all your payroll to the ERC because you don't need to allocate any to the PPP2 loan, second draw loan forgiveness application, which you're going to be doing sometime during this year. So again, this is the key. Get your loan forgiven, okay? Second, maximize your credit. Third, you can't use the same payroll for both. So what's the goal here? What's the strategy here? The strategy is on your PPP loan forgiveness form. You want to report the smallest payroll amount of dollars that you spent to assure you'll get full forgiveness. Now that number has to be at least 60% of your loan, your PPP loan. So if you borrowed $1 million, PPP1 or PPP2, you have to at least put $600,000 of payroll on your forgiveness form, or you won't get your whole loan forgiven. And if you can put only 60% down, and you can also report non-payroll eligible expenses as defined by the PPP, and that has to be less than 40%, then you're doing the best you can to save payroll dollars that you can use on your ERC calculation. So what are some of these non-payroll eligible expenses? I think when we throw them up on the slide too, you're going to remember them. One was business mortgage interest. If you owned your property and you had interest expense on your books. Second is rent, if you were leasing your space instead of owning it. Third was utilities. And then later on in the process, they added, the SBA added a number of covered expenses, including things like protective equipment, gloves and gowns and things like that, and partitions that restaurants had to have between tables, all of those things. So if you have a PPP loan to get forgiven and you have an ERC credit that you're eligible for, you've got to spend some time here. This is complicated and it's a little bit of heavy lifting, and we've done a lot of that with clients. So if you have this situation, please reach out to us and we can assist you. So I'm going to reiterate a couple of things because these are important, and a lot of, you hear it more than once, you remember. In 2020, the maximum ERC credit for the year was $5,000. And as Harry said, you had to reach that $50,000 reduction, 50% reduction in revenue in a quarter in 2020 versus 19 to qualify. So the hurdles to jump over to be qualified for 2020 were high, okay? And the benefit was really not that fantastic relative to what they did in 2021. So somebody in Congress decided that we're going to make it easier for you to get your ERC credit in 21 by reducing the amount of reduction in gross receipts by quarter to 20% when it was 50% last year. And we're going to increase the amount of money that you can get per employee per the calendar for every quarter in 2020 you're eligible. So if you're eligible for all 4 quarters in 21, you can get $28,000 back per employee. That is huge. That is huge. So we're recommending to all of our clients to take a look at their revenue. It's on a calendar basis. So everybody's March is over with and everybody's June is now over with. Take a look at your revenue for the first quarter of 2021 and the second quarter of 2021. Compare it to the same quarters in 2019. Okay. And if you're down 20%, you're eligible for a credit. And we have a lot of clients who have been recovering, but they've been down more than 20% in quarter 1, and they've been able to apply for a credit. How do you calculate what your credit is? Well, you have to go through a calculation of all of your employees and how much they were paid during the period that you're eligible, whether it's 20 or the quarter in 21. You're also going to provide this schedule, and I'm going to show you what a schedule looks like in a second. You're going to provide that schedule to your payroll company, because your payroll companies, for most of our clients, they're the ones who are preparing your quarterly payroll tax return. That's a Form 941. We generally don't prepare those for clients. The payroll companies do. You're going to provide that payroll information to your payroll company, and they will then go and prepare a 941 for a quarter that has not been filed for yet, or they will amend a previously filed quarter. So if you're eligible for an ERC credit for 2020, and it's for the second quarter and the third quarter when you qualified, then the payroll company will go back and amend Q2 and Q3 941s for 2024. And then you should be receiving a check from the IRS or the US Treasury for the amount of your ERC credit that you've calculated. Or they may issue a credit toward future payroll taxes. So I'm going to give you a little example. So let's pretend we have a company. This is Harry's Pizzeria, and Harry has 2 employees, Joe and Mary. And so the first column that you have is how many dollars of wages did you pay Joe and Mary? And in our case, for the whole year of 2000, because this is an annual calculation, Joe was paid $6,000 and Mary was paid $12,000. The IRS says that qualified wages can also include the net employer health benefits paid for by the company. So we're making an assumption that the company paid $2,000 in 2020 for Joe and Mary for their health insurance. So the next column is qualified wages. It's just an addition of the wages paid plus the employer portion of the health. We're up to $8,000. Now, the cap for this calculation for 2020, as Harry said, was $10,000. So Joe is not to the $10,000 cap. So the next column is the eligible wages that he is qualified to get the ERC for, and that's the 8,000. And then in 2020, as Harry said, the credit was 50%. So the company that paid Joe wages will get a credit back, a check back for $4,000 for Joe. And Mary, she made more than Joe. She's over the $10,000 cap between what she was paid and her health insurance, and her total was $14,000. That's capped at 10. 10 times 50% is 5,000. And if you had 25 employees or 100 employees, you would continue this calculation. And this is the calculation that you would forward to your payroll company. And they would use this information to go back and amend payroll tax returns and file those with the government, and then you would get your check from the US Treasury. Next, I want to show you the same fact pattern, except we're moving to 2021. And again, the two things that change are we're going from an annual calculation to a quarterly calculation. We're going from a 50% credit against eligible wages, qualified wages, and we're moving that up to 70. So the first four columns are exactly the same between the 2 years, except in 2021, these are amounts that Joe and Mary were paid for the first quarter, assuming the first quarter the company was eligible for ERC. They had the 20% drop in revenue between 21 and 19. Then they also had the 2,000 of health insurance, so their qualified wages are 8 and 14,000. Joe does not hit the cap, so his number is based on 8,000, but the credit's up to 70%. So instead of $4,000, his credit last year, his credit's up to $5,600, and Mary's credit is $10,000 times the 70% credit. If these are the only two employees, $12,000 credit would be due to Harry's Pizzeria, and his payroll company would file that payroll tax return on his behalf. So this is the slide we showed earlier at the very beginning. These are the programs that they use basically the same gross receipts test. And the gross receipts test is obviously important because that's the calculation that everybody has to go through to determine whether or not, first in the PP2 world, for those of you who received a PPP second draw loan at the end of 2020 or early 21, you know that you had to have had quarterly receipts reduction between a quarter in 20 and 19 to qualify for PPP2. Okay, that was 25%. And as Harry has gone through, the ERC number for last year was 50%, and the ERC drop for 21 is 20%. So 25, 50, 20, don't mix them up. When you're talking about, when you are analyzing ERC 21, you got to look at ERC 21 all by itself, okay? And there's the maximum benefit of things. So I'm going to end by this, and then we'll go to questions. This is complicated. For all of us who remember the PPP rules, the SBA sent out authoritative literature all the time, and we used to kid and lament that the goalposts were changing constantly. Well, we would like the goalposts to change a little bit more, I think, with the ERC program. As I said, on March 1st, we got a 100-page document, a tax notice, which was the only authoritative documentation we had on the subject. We've had a couple of small tax notices since then, but nothing urgent. And as Harry talked about, this shutdown, partial or full, and do you qualify and all that, the March 1st documentation gave us some insight, but there's so many questions that are still outstanding. The good news about the ERC is you have plenty of time to go back and amend a return, in fact, and get money back. In fact, you have 3 years from the day that the payroll tax quarterly filing was made, so to amend a return. So if you think you might qualify for Q2 of 2020, then that would have been filed. It was for the period ended June 30th. It would have been filed by July 31st of 2020. You have until July 31st of 2023 to actually amend that return. Okay, so there's plenty of time, and hopefully the IRS will catch up with all the other things they're behind on and give us some more information, more guidance on that. So with that, we're going to turn to Q&A session. And please feel free to type in any questions, and we'll turn this over to our colleague Greg Mason, who will handle those questions and parse them out to Harry and me.
Okay, we have, first question is, I own an S Corp. Do my wages qualify for ERC?
Want me to take that, Harry? Okay.
Yeah, sure. Thanks, Marty.
The answer to that question is we're not quite sure. There is really nothing that I've seen in the authoritative guidance from the IRS to say that it is deductible or it is eligible for the ERC credit. You know, that's a chart we just had with Joe and Mary. If your name is Marty and you're the owner, can you put your name and your payroll dollars on that line, on that schedule, and give it to the payroll company? There is commentary out there in our profession that says you can't. The husband and wife can, if they're owners, put their payroll dollars on the ERC calculation, but any of their relatives they can't, like their kids and stuff. There's other people who contend that unless you own less than 50% of a company, then you cannot, and you're an owner, that if you own 51% of a company, your wages could not be eligible for ERC. But if you own 49%, you would be. So I hate to not be able to give you a good answer, but this is an example of we just don't have enough information from the IRS. I hope that they'll allow the owner's payroll to be included, whether they're above or below 50%. But hopefully we'll get some information one of these days.
Okay, another question. The cap of qualified wages is $10,000 annually per employee for 2020 and $10,000 per quarter per employee in 2021. Is that correct?
Yep. I answered that in the chat, but just so in case everybody hasn't seen it, yes. So that's what makes 2021 such a potential for such a bigger credit. For 2020, you were capped at $10,000 of qualified wages per employee for the whole year, but for 2021, it's $10,000 of qualified wages per quarter per employee.
And then the follow-up to that is how long do we have to amend a return?
Yep. So typically, you can amend a return within 3 years from when the return is filed. And I believe most payroll returns are filed about 30 days after the quarter end.
So we have time. And if you have questions, call us, because we'd be happy to help. And if we're not sure of an answer, we'll tell you that. And if you have a question that we don't think there's authoritative guidance on, we'll tell you that as well.
Yeah, because we've definitely seen some, depending on who your payroll provider is, they might not be as familiar with the forms or how to amend a return. So, just because they can't amend it doesn't mean that it can't be amended. So definitely, if you run into any issues with your payroll provider trying to get any of these returns done or amended, let us know and we can help.
We mentioned this earlier, but what we're recommending to all of our clients, unless it's a slam dunk that you know the answer, take a look at your quarterly revenue, your receipts for each quarter of 2021, and go back and compare it to 2019. It won't take you more than a few minutes. And if by any chance you exceed that 20% drop, it's well worth your while. I can tell you in the last week, I've been talking to a company they will get a ERC credit of over $100,000 for quarter one of 2021. Another one, $225,000. They just sent into their payroll company, and we have a client that is going to get back over $350,000 for 2020. So the quick and dirty calculation you do is for 2020, how many employees do you have? 20 employees. You might get 20 times $5,000, like Harry showed. It's worth potentially $100,000. So spend 5 minutes and take a look at it.
Someone's asking to have us discuss shutdown requirement.
Yeah. And I mean, I can start it, Marty, you can chime in.
You go.
This is, it's a difficult question to sort of cover. I mean, it's so facts and circumstances that really, when we talk to people about it, it's sort of them kind of explaining to us their specific situation, and then we kind of, go through it together. But just for, example purposes, if there was you have a restaurant business and you had the government shutdown where you couldn't have people inside, but restaurants were, if that particular restaurant was able to still do takeout and keep some of its business going, depending on how much of that business was able to keep going, they might not be considered to have a partial shutdown. For accountants, we were able to work from home, so we weren't really impacted. So that something like that wouldn't qualify either. I know there's clients that have come to us with, we've got 5 different service lines. One of the service lines was completely shut down, but they still had 3 of them operating pretty much the way they had been. It really comes down to the IRS is very vague. They use terms like, is it a nominal part of your business? So if you do have a situation where you think it could be, it probably makes sense to talk with us. But I think one thing that we've told everybody is that there's no slam dunk when it comes to this shutdown requirement. And the IRS hasn't come out with a lot of guidance. And largely it's probably because they haven't really gone through and audited any of these yet. So I don't know if they're going to be preemptive about that guidance, or if it's going to be something where as they start to look at, what people have considered to be partial or full shutdowns, and then they look at it and they say, well, I don't think you were, then maybe we start to get more information about it. But I think for purposes right now, it's really on a case-by-case basis. I don't know if that completely answers your question, but if you have a specific example, definitely feel free to email us or give us a call. We can talk through it.
I could add a couple of things too. If you read the literature from the IRS, it says that you had to have a partial or full shutdown required by proclaimed by the government, and it listed 3 agencies. They were all federal agencies, but that has been expanded to include somebody like Governor Baker or Mayor Marty Walsh. So we've got clients that were doing construction work in Boston or Somerville or Cambridge, and the mayors of those communities said no construction. So for them, assuming the amount of revenue is significant enough, they should be able to at least try to get the ERC credit in 2020, because the government told them they had to shut down, and it has to be related to COVID too. So I alluded to a March 100-page document from the IRS. One of the nice things about the document, the authoritative language, they gave us about 30 or 40 examples of companies, and so it was easy to follow those examples because it's a lot easier than reading what the lawyers all write in these laws. But unfortunately, they probably needed to have 500 examples to help us, and so that's what we're waiting for, is a few more answers. But so there's a lot of questions about the partial and full shutdown and whether or not people qualify. But the good news is you got lots of time to amend those returns. And hopefully in the meantime, we will have some information from the IRS, more information.
There's 2 more questions which I can answer, and then Marty, feel free to correct me or add more. One of them was, is it total, if you do have a partial shutdown, are you only looking at the gross receipts from the part that's shut down, or do you look at it from the whole, your whole business still? And the purposes of looking at the partial shutdown is only to see if you actually do qualify for the ERC. When but for purposes of the revenue, you would still look at, for like the gross receipts test, you would still look at all of your gross receipts, even if some of that business was shut down and some of it wasn't. So let me know if that did answer your question or not, or if you're thinking about it from a different perspective. And then the other one was, do we need both shutdown and reduction in revenue during the quarter in question? And that's the answer to that is no. It's for 2020 where you look at it from an either or, and same for 2021. So that's why what I usually tell people is the gross receipts is the most clear answer. So if you know that you qualify under the gross receipts test, it's usually the best way to go if you know that if you do meet that test. And then if not, then then looking at it from a partial or full shutdown is what I would look at next.
Well done, Harry.
Thanks, Mike.
That's all the questions.
Okay. Well, thank you very much for joining us today. And we will, at Stone Dealing, continue to our goal is to have one webinar a month. And as I said, the webinar, the next one that's tentatively scheduled is August 19th. And we'll have a couple of our colleagues talking about lease accounting rules, which if you think that the ERC rules are complicated, the lease accounting rules are probably a lot more complicated, and they're going to require a lot of your attention if you have a number of leases, and your financials, particularly your balance sheet, it's going to look a lot different. So please tune in for that and look for that invitation in the email as we get closer to August. Enjoy the 4th of July holiday, and hopefully it won't rain the entire weekend. So
Marty,
thanks
sorry,
for joining us.
not to cut you off. If we have time, I know there's one more question out there, and
Great.
I'll answer it fast. But so
We have plenty of time, Harry.
I don't. Yeah. So if the shutdown piece is down by the qualifying percentage, but total is not, what do I do? And so the shutdown piece is sort of separate from the qualifying, that 50%, 20% drop. So they're two different, and that's what makes the shutdown piece hard, is that there's no sort of number or bright line test. So for purposes of the shutdown piece, you would look at it from that period that you were shut down. So it's not necessarily by quarter. You could be shut down halfway through a quarter, through halfway of another quarter, and you would look at your qualified wages paid during that period if you were using shutdown as the reason why you qualify for the ERC. Otherwise, you would just look at the percentage drop, 50% for quarters in 2020 or 20% for 2021 versus 2019. So they're sort of two separate pieces. And if you're using that gross receipts test for the quarters, then it would just go by the quarter that qualifies. So it's a little bit different in terms of the period that you would look at the wages.
Perfect response.
Anything else? A couple minutes.
Yeah.
Okay, well, thank you, and everybody have a great holiday weekend.
Yes, happy 4th. Thanks,
All right.
everybody. Thanks, Martin.
Thanks, Harry. Thanks, Craig.